All right. Look, thank you very much, everybody. Against my better instincts, we're going to start on time. So thank you very much for coming along to this morning's breakfast. It's a pleasure for me to welcome you all here. My name is Toby Potter, and I chair IMAP, which is the Institute of Managed Account Professionals. So this is one of a series of breakfasts which we're holding on a regular basis. In fact, between now and Christmas, as you'll see, we have a number of similar events. These seem to me to, as managed accounts develop, one of the investments is clearly a crucial part of the way in which good managed account services are going to be developed for advice businesses. And so through these breakfasts, we aim to focus each time on a little aspect of the investment process that goes into putting together managed account programs. It's a pleasure for us today to welcome three presenters. Con McAvaney from Private Investment Consulting, part of National Australia Bank's consulting business. Con is a senior investment consultant within PIC. Lucas de Pourbaix, who will be known to many of you as Chief Investment Officer for Lonsec and closely involved in the development of managed account portfolios for a large number of advice businesses. And Richard Close, who has kindly agreed to step in. Richard is Director of Institutional Distribution at Antares. Our original speaker was Andrew Hamilton, but for family reasons, Andrew's had to withdraw, and so Richard has agreed to step in at about 24 hours' notice and to speak to Andrew's slides. So, Richard, thank you very much for doing that. Three things which we're doing, which I wanted to just talk a little about. So we run 3 community of interest groups, I guess you'd call them. So one of them is a data group made up of about 20 managed account providers and fund managers as we try and establish standards for the transmission of data between model managers and platforms. And as Tracy Abercrombie from Schroders and I were talking about today, there are a number of other areas, for example, performance reporting, for example, narratives around portfolios, and Tracy's current favourite, the transmission of rebates. Everybody, young industry, everybody's developed proprietary standards, and so they're all proprietary processes. And so a key part of what we're doing here is to try and get some agreed standards. What does a rebate file look like? What's in it? How often? So on and so forth. What does a file that transfers model changes from the manager to the platform look like? Regulatory group, which Adam Seckham, who will be known to many of you from BlackRock and Implemented Portfolios, is convening. That group is really there to try and manage our relationships with ASIC, and so as a two-way flow, both making sure ASIC understand about managed accounts and making sure that the managed account community, you all and your colleagues, understand a little more that we can transfer to you ASIC's, and the regulators' feeling about managed accounts. We're currently compiling a submission for the Royal Commission, focusing on 5 of the questions which the Royal Commission asked in its interim report. Can conflicts be managed? Then a set of questions about whether advisors should be able to be product manufacturers, or whether product manufacturers should be able to give advice. And then the last question is, do we need structural change? So we're putting together a submission by the end of next week addressing those questions, and some of you may have seen an email from us last week inviting your feedback, and we've had quite a bit of feedback on those questions. And then next year we'll be putting together an investment group to help focus these types of sessions and our portfolio management conference on what topics should we be covering? Who should we be involving in that? I'm actually looking for a convener for that at the moment. So if you have any suggestions, I'm open to them. So without further ado, and that's been plenty of ado, let me hand over to the first of our speakers, Con McAvaney from Private Investment Consulting. So the format of today is that I put to each of them the proposition that developing a portfolio for a managed account client, you have to really be conscious of the risks that portfolio has to be set up to face into. And they should talk to the risks that seem to each of them to be the most significant risk or risks that currently face a client. And so the format of today's session is each of them is going to talk for 5 to 10 minutes about the risks that seem to them to be central or key or of most importance to putting together a managed account portfolio. And then we'll have a panel discussion to try and draw together a portfolio that reflects each of their, or deals with, or combines each of their views. So they've each only got essentially one slide, or in some cases one's interpreted as two. Just a slide to really talk about risk in a managed account portfolio construction sense, and then we'll try and draw those threads together into the way a portfolio might be constructed. So, Con, over to you.
Thanks, Tony. In terms of what we think really about what the key risks are, I've got one slide, so hopefully that does help me to get focused. So we've got two groups of clients, if I'm to simplify it. Basically, we help advisors trying to construct portfolios for their clients who are either accumulating or they are in retirement phase, or they might have some not-for-profit clients who are really trying to maximize the income that they get from their capital so that they can fund their activities either into perpetuity or for a very long time. And pretty much I think the risks on the latter look quite significant for us, particularly in the context where we are, because they're faced with sequencing risk, where basically they have put in large sums of capital into their portfolios already. They've put large sums of cash flows, and pretty much we've had a very long bull market. If it's bond markets, it's almost like 30 years of yields coming down significantly. And if it's equity markets, pretty much from about 2009 or 2010, basically it's been a one-way trip. And if you look across many asset classes, particularly growth assets, last year you were looking at about between inflation plus 4.5% to about inflation plus 17.5%, thanks to the weakness of the Aussie dollar relative to the US dollar. And even if you had to go back, say, 5 years, 7 years, pretty much you're seeing a sort of a spectrum of returns. So investors really have been beneficiaries of good growth in terms of growth assets in particular. And fixed income assets have held up reasonably despite the long duration and sort of interest sensitivity that they do face in terms of where the cycle is at the moment. So pretty much our ideal scenario would want to make sure that we can smoothen the profile or the journey of those group of clients, particularly in the drawing down phase or just about to get into the drawing down phase, because they might end up having to downsize their lifestyles, or they have to reduce whatever their budgets are. And so for us, that's a key risk. So when we're building portfolios pretty much that have got two objectives: the real return objective and a risk objective, which we prefer to express it as the limiting the number of incidents of negative returns in any sort of considerable period of time. Typically, we take the 20-year number as the sort of a standard period we use. And so that sort of number gives us an idea of, you know, how much investors can sort of lose and participate on the downside. And so with that context, that is what we face. I think I want to just maybe start to sort of focus it and say, what you also see is that you've got your equity markets on one side or growth assets on one side, then you've got your long duration fixed income assets on the other end. And typically, you know, we portfolio constructors have always leveraged on the diversification components that come out of, you know, your fixed income assets being able to diversify your equity markets. But then with that being said, we've seen times whereby actually those correlations, when you actually need them the most, they break down. And so the question is, there is a gap that typically exists whenever we face situations that we are in at this point in time. Markets tried to correct in the last few days or in the last week, but as they did in February, I think we've seen that they're starting to kind of come up. Volatility has also started to come back from the 25% to about 18% if you're looking at the VIX or if you're looking at the AVIX. And so this chart basically helps me just to bring the kind of key point for us as to, you know, what we are concerned about is the breaking down of those traditional asset classes correlation structures. And so if you look at, so I've got a group of the red or brown sort of bars, that's your growth assets, and then the green ones are your fixed income related assets, and then the blues are kind of aggregated alternative investments. And so we think that that's where, if you want to diversify or sort of try to mitigate some of the potential risk in your growth assets, where we see high levels of elevation in terms of valuations, you can see that almost at every crisis sort of point in the last, whether it's the 97 Asian crisis, the GFC, they've sort of, even though they've tanked similarly to equity market, they've actually held up quite well or better than your sort of traditional asset classes. So we think that in sort of constructing portfolios, that should be looked at and considered quite carefully. I'm going to pause at this point. Yeah.
All right. Now what I'd like to do is hand over to Lucas to talk about Lonsec's view of the key risks that we're facing into at this stage.
So my chart's quite different. So the low interest party bus. So further to what Cons, I guess, commented on, we've had an extended period of, markets really fueled by liquidity and leverage. And if you think about any market cycle over history, generally the things that have unwind cycles are related to leverage and liquidity. So if you think about quantitative easing, we've had central banks in the US, in Europe, but also in China, pump massive amounts of liquidity in the markets, which is held and which has been conducive to equity markets and growth assets. Now, in such an environment, everything goes up, and there is generally you'll get bubbles forming, and parts of the market which sort of accelerate a lot harder than others. And you see that with some of the tech stocks, obviously, in the US market, which have certainly been the driver of markets within that sector. At the same time, we've had, from a bottom-up perspective, companies being able to access cheap debt. So as interest rates have come down, from a bottom-up company perspective, they've had ability to really grow on the back of cheap debt. Now, that environment is starting to change. We're seeing the Fed tighten and raise rates. So that access to cheap debt and certainly asset classes that are priced sensitive to the bond yields, those are coming under increased pressure. I guess more broadly, the other thing we're thinking about is geopolitics. Now, geopolitics are always around. They're not a new thing, but we do think that this time around, particularly with things like trade wars, they are having an impact in terms of creating volatility in the market, but they are also having an impact in terms of potentially long-term growth. And you're already seeing within the Chinese market and the impact of US sort of Trump's strategy of harmonising tariffs between countries starting to have an impact on the Chinese economy, because despite China having a long-term goal of being a consumption-led economy, it is still very much an export-based economy. So that if that continues, that may have a longer-term impact on growth. So we've had, in a nutshell, really 10 years of fantastic returns. If we look at our long-term forecasts for asset classes, generally returns have been in excess of those long-term forecasts, which has been a really good outcome for clients. The risk is that portfolios generally have gravitated to those areas that have done really well and possibly been less diversified. So, you know, if you've had exposure just to beta, just to the market, that's been a great strategy because everything's gone up, okay? Growth, if you look at investment styles, growth has outstripped value by a mile in recent years. So the risk is really that we've become complacent, and that by proxy of the market going up, we've maybe had portfolios that are too focused in certain areas. So the key thing we're increasingly thinking about is the need for diversification, and not only asset class diversification, but diversification within asset classes. So if you think about that more from a granular perspective, if we look at equities, diversity of styles, so value, growth as an example, but also diversification of strategy. Do you look at long short more as a key part of the portfolio, where if we do get more divergence in returns, which our expectation is that we will, that strategies that can maximise and generate returns from that. Within fixed income as well, again, we've seen some parts of the fixed income markets do really well. Some of those parts are more correlated to the equity part of the market, and also we need to be conscious that within that part of the portfolio, despite you still need some duration. So there's been a sort of big shift out of duration because of the notion that interest rates will go up, but we still think duration has a role to play. And some portfolios that we've seen in the market has probably swung too far the other way, where yes, they're getting nice yields, but to be honest, they're very correlated to equities in that fixed income part of the market. So I think it's a time to sort of look at portfolios, look at not only asset class diversification, and certainly we've been allocating more to things like alternatives within our portfolios, with a view to add that diversification in terms of being able to access different sort of sources of returns, but also intra-asset class, ensuring that we're not all anchored to one bet. And we do think that the increased dispersion is going to be more conducive to active management. So beta absolutely has a role to play, but the more dispersion you get, there will be more opportunities, we think, for quality managers to add value through active stock selection. So I'll leave it at that and pass on to the next speaker.
Thank you very much, Lucas. Now, our final speaker is Richard Close. Now, Antares, as of course you all know, are a specialist Australian equities manager. So Richard's perspective is, rather than the more diversified portfolios that Con and Lucas have talked about, they're really focused on the Australian equities component, and then we'll try and draw the threads together.
Thank you, Toby. As Toby mentioned before, I was pulled in at the last minute to do this, so if I can sort of speak to Andrew Hamilton's slides, our head of research, and I pull it off, that is proof that our process works. Okay. Risks. Coming last, you posed the risk of having to speak for the third time on the same things. At the moment, we see plenty of risk, but obviously, where bond yields are at the moment, it is our major concern. On top of that, obviously, the trade jitters, China. It's not just that; it's NAFTA and Europe as well that Trump is managing to pick fights with. Geopolitical stability, what's going on in the South China Sea at the moment. I think that, particularly for us living in Asia Pacific and ourselves as being Aussie equity managers, is a bit of a concern with China sort of flexing their muscles. The managing of Brexit, or the mismanaging of Brexit, as the case may be, there's no shortage of risks on the global stage. Another one I would sort of pose at the moment is what happens with China. They need to deleverage. Their economy is at full capacity, and that's something we're going to have to face up to, certainly in the next 18 months. Domestically, we are facing a property market, which I think everybody, or most people would agree, that is now radically overheated. And what are the implications for that on our banks, who are also, of course, being faced at the moment with the Royal Commission and the adverse findings out of that. The banks, don't forget, represent 4 of our top 10 companies in this country, and a massive consideration when building a portfolio. Finally, another domestic risk we see is retail trade. There are 2 aspects there. Number one is the wealth effect that has been caused by a rising property market will affect retail trade, guaranteed. It probably is already. The second thing, of course, is the influx of the dot-com companies, and I speak specifically there probably about Amazon. That will be an increasing influence over our domestic retailers, listed retailers, over the next 12 months. Most importantly, though, is none of this is new. It's not different this time. There are always risks in the market. And I've been in this business quite some time now, and there's always something. There was the commodities slump in the late 90s. There was the Asian collapse, yada yada. None of it changes. Markets are forward-looking, and of course that creates uncertainty about the future, and that risk that you get from that uncertainty is what helps you get returns. We were asked to speak about what we saw as the major risk, though, at the moment. For us, as Aussie equity managers, valuation is the concerning thing for us. The rising bond yield market and what implication that has for valuation. Bond markets peaked in '82. We've seen yields coming down for 36 years, and what that means is that there is a raft of people working in markets today that have no idea what the opposite looks like. And we've got to think about that. We've got to think about what implication of a new bear market for bonds will have on a whole lot of people in the marketplace that have never seen it before. Now, we have seen rising rates in the United States in recent times. That didn't have any effect up until last week on equity valuations, as people became euphoric about what the recovery of the United States might mean. But of course, overlaid on top of that is things like, the trade wars, etc., that act sometimes as a catalyst for that valuation check. I worked with a fellow called Dr. Don Stammer, who I'm sure many of you know, when I was with Deutsche Bank over in London some time ago. And I used to take him around to see European and UK fund managers. Don's comment about risk was always, you could name all the things that the strategists and the economists talk about, but Don always talked about the X factor. Collapses in markets, major market corrections, are always caused by what we don't expect, the things we don't know. So how do we manage for those? How do we manage the risk in those cases? And in our context, as an Aussie equity manager, for us, the rising bond yield market has an impact on our valuations. And as long-term managers of equities, valuations are the number one thing for us. Obviously, higher bond yields mean higher discount rates, changes how we construct our MPVs, and has dramatic effects on valuations. It also signals stronger economic activity and the potential for recession further down the line, but that's not so much the game that we're in, as we don't sort of see ourselves as being macro forecasters. We're very much company focused. We're asked to speak a little bit about risk control. The way we control risk, particularly in markets like this, but our approach is always consistent, and that is we understand the companies that we're going to invest in. That is our form of risk control. We know the company inside out. We know the company structure, we know the industry that it operates in. We have a very, very close relationship with management to try and understand whether they're capable of executing the strategies they talk about. We have very strong ESG research and considerations which are factored into our valuations for our companies. So what we want to do is value the company correctly over the long term. We model 10 years forward cash flows. 10 years forward cash flows and balance sheet to give a very robust view of the company. And then we obviously compare with current share prices to see whether or not there's opportunities or sell signals or what have you. Most importantly for us, managing for risk, is that we don't use short-term views on discount rates or interest rates. We use a long-term interest rate assumption for our DCF calculations. So, you know, as I said before, 10-year DCFs, we look through cycles. So what happened last Thursday really means not much to us. We actually had an equity, we have a quarterly equity day in-house where we're locked in at 8:30 in the morning and not let out till 5 o'clock, and we just talk about stocks all day, what the major changes have been. It's a bit of an in-house discipline that we have. And on Thursday, of course, the market was falling apart. It doesn't really concern us. On top of that, obviously, we do lots of scenarios and sensitivities across our companies, so we understand the range of potential outcomes that we could potentially come across. We have 8 analysts, and we do 120 stocks. That's an average of 15 stocks per analyst, compared with most other fund managers who are doing around about 30 or 40 stocks per analyst. That's another way of managing your risk. We know the companies inside out. And does it work? There's always a lot of criticism about active managers and whether or not you're getting anything for your fees. Yes, it does in our case, because we've outperformed in every single major market downturn since we started up 24 years ago as portfolio partners. Every single major market correction down, we've outperformed. So that long-term view of understanding the company and being able to value it enables us to manage our risk in equity markets. Obviously, the normal arguments about diversification in the portfolio, which I think apply to most good managers, but it is valuation which is the strongest risk management tool for us. Just before I finish up, we're not a value manager and we're not a growth manager. So yes, we've probably not done as well as perhaps we could have with this sort of frothy market that we've seen over the last 10 years, but particularly the last 18 months. But we don't aim to chase stocks when valuations get high. Because of our methodology, we tend to have a natural form of style rotation. So with that 10-year DCF, we will move between value and growth, depending on where we see the market at the moment. Hopefully we don't plunge off that cliff when growth stocks do what they did on Thursday, and what I suspect they're probably going to do at some stage in the next few weeks again. And similarly, we don't sit around for 10 years with a deep value hat on, waiting for something to happen. I think it was Buffett, may be wrong here, but Buffett who said, you know, value managers always sound like the smartest people in the room, but it's the growth managers who get rich. I might pull up there.
Thank you, Richard. Now, so before we get going on a more generalised discussion, are there any particular questions which you have of any of our 3 presenters about their content?
Lucas, I wholeheartedly agree with the sentiments you expressed in your piece. I wouldn't mind drawing out a couple more details about what
Yeah, yeah. So the first part of the question, yes, I'm referring to interest rate duration. From a portfolio construction perspective, from a broad level, we sort of, I guess, distill the fixed income portfolio into three broad buckets. So one is duration, then credit, and then I guess absolute, more absolute return type focus strategies. And we will sort of, I guess, weight those segments depending on the view. How we practically implement that. So, for the duration aspect, we'll tend to have exposure to managers that are benchmarked against a more traditional, whether it's the composite or the global ag, active strategies at the moment. But generally will have a longer duration within their portfolio. Outside of that, most of our exposure is in sort of short duration credit securities at the short end of the curve, floating rate in nature. We haven't been chasing any of the high yield parts of the market. So it's tended to be sort of conservative floating rate type securities that we've had exposure to. And maybe that, from a return perspective, we've missed out because we haven't been in some of those high yield, but we're pretty comfortable with that, being at that more conservative end. But it does become, from an implementation perspective, where it becomes challenging is obviously many of you, there's been a lot of different bond strategies come out to the market. You've had a lot of these sort of, call them index unconstrained strategies that can go anywhere between cash right up to emerging market debt and high yield and so forth. So the sort of rule of thumb I use is to say, well, what's the objective? If your objective is cash +3, well, that's a pretty high objective for fixed income. So you will have to, that manager will have to be taking on a fair bit of risk to get that return. And there's nothing wrong with that. Our view has been to be more conservative, though, in that part of the market.
The other question actually was around alternatives, and you mentioned that A, you were increasing your weighting, but B, you mentioned long short, and to my mind, in the alternative space, it's the opportunity to, because beta is kind of pretty much either very expensive or expensive in almost any asset class. So the alternatives space offers the opportunity to get non-directional, like relative value, alpha rather than directional.
Yeah.
So from mentioning long short, is that the sort of what you're seeking? And outside of just playing long short, are there other strategies?
Yeah. So within alternatives allocation, generally what we've been as a I guess call it a anchor approach, we've gone for more diversified strategies. So whether that's sort of systematic sort of diversified beta strategies or sort of alternative beta strategies, or your multi-asset type structures that can have elements of relative value. They might be looking at currencies, bonds, equities, on long and short and so forth. So a more diversified approach. Now, a lot of these strategies haven't done as well in recent years. So even your managed futures strategies haven't done as well, but you wouldn't expect them to do well in the environment we've had in recent years. So that's probably the area we've been focusing on the most. In terms of long-short equity, we actually, depends what type of long-short. So market neutral, we'll use that more in a pure alternatives allocation. But long-short managers which really have, a beta of, 0.6 or we just include that as part of equities as more of a variable beta type strategy where the manager can manage their exposure to the market by shorting and cash.
Now, Richard, Antares has a long-short fund in the Australian market. Do you want to talk a little to this point about the role of long-short?
Yeah, look, I'm not actually. If you go back to that slide, I didn't speak to this. That actually happens to be.
I knew this.
That was Dorothy Dixer. I needed that. Our high growth strategy by Richard Dixon. Interestingly enough, that green that green, this is attribution analysis, by the way, for those who don't know. The blue bars are the part of our performance which come from style, which is value growth, i.e. not much. The yellow is sectoral returns. The grey bars, it says here, could you just move your head for a second, Lucas? Is a return adjustment, but because Richard does a fair amount of inter-month trading, this is a monthly attribution chart, so it doesn't actually pick up the intra-month trades. And so there's probably a component of each of those in that grey adjustment. But where we get most of our alpha here is stock-specific return on the long and short side. And the black line is the 12-month, is the absolute 12-month active return. There's an orange bar there for active country return, which is effectively the role of currency in the earnings of Australian companies. So there'd be an effect there from companies like CSL or Qantas or what have you. We don't, as a house, have a view on talking to investors about the role of, this is a 1-20-20 strategy, but we do know at the moment it's becoming an increasingly more attractive alternative for investors, and we've seen a lot of money go into it. Interestingly, we've seen a lot more institutional interest in it, particularly over the last 3 or 4 months. So that gives you some insight into the way the institutions are thinking about the alternative space.
All right. So before we move on, are there any other questions? Richard, yeah. I meant to say turn your phones off before the.
My wife just checking where I am. Richard, you talk about market risks. You could argue that if it's a known risk already in the market, therefore almost risking the unknown. But the risks that we know about, which of the main ones are mispriced at the moment?
I agree with your comment, first of all, and I think it's why I made that comment about the X factor from Don Stammer. Never a truer word was spoken. I often look at people, particularly, the market strategists that come around from brokers and things like that. And I was an institutional stockbroker for quite some time myself, and there's a lot of waffle go on about the risks in the marketplace. I think they're just finding space on slide decks to fill up, because they should be priced into the market if we have any understanding of rational markets. A lot of that should be priced in. Again, I don't know what it is that's out there that is going to spook the living daylights out of us, but I know it's out there. And of course, when that happens, it's like a flat tyre. If you're going at 200 kilometres an hour and your tyre blows out, you're going to have a pretty serious accident. If you're only going 30 k's an hour, you can slow up and correct. We're probably going about 120 kilometres an hour at the moment. And I don't know what that change is going to be. If you ask me personally, I think domestically it's going to be the property market.
Which of the current known risks are mispriced?
Are mispriced. Look, as a house, we don't do macro forecasting. So I think it'd probably be wrong for me, as a personal view. I think probably the impact of the rising bond yields in the United States and the impact it had particularly last week, I think that, at the end of the day, the US economy has got a lot of room to grow. It has got capacity. It is pushing the upper limit at the moment in terms of the unemployment rate. But if you go and look deeper at the numbers, you'll see that there are actually a lot of people that are not participating in the workforce in the United States at the moment. So there's room there. And common sense tells you that they've had 15, 20 years of buying off the Chinese, etc., and their own domestic manufacturing sector has sort of deteriorated. Common sense tells you it just didn't turn around since Trump got into power. So I suspect there's a lot of room there, and I think we'll get more comfortable with economic growth in the United States again.
Because one of the, if I can just interrupt, I mean, one of the options about misprice, Richard, is risks that are misunderstood. They're priced for an understanding that will turn out to be incorrect. I think Grant Samuel were quoted this morning as saying that they think US cash rates are going to 4% in the near future, and that the market's pricing for a 3 to 3.5% short-term US rates.
Yeah, look, I think it goes back to, as I said before, 36 years we've been in this bull market. There are generations of people that I've worked with on trading floors who have no idea what the alternative looks like. So kind of common sense tells you that when all of a sudden it reverses and goes the other way, they're going to panic. That psychology thing swings both ways, and I think we're seeing a bit of that in terms of the concerns over bond yields at the moment.
So let's bring the discussion then back to the advice that you'd give the investment committee of an advisory business putting together their balanced growth, conservative, managed account portfolios. So Lucas and Con, I mean, you and your organisations are actively involved in giving advice to those investment committees. So today, whatever it is, 15th of October, what should be the approach they take?
So we had our investment committee last week, for our asset allocation investment committee. And just for context, I mean, within that investment committee, obviously, we've got our sector leads, we've got external members, so Felix Stephen, some of you may know, used to be head up strategy at Advance, and Damien Hennessy, who years and years ago used to be CIO at HSBC. And so it's a pretty good forum in terms of looking at these things. But the things we focus on are, so valuation, where we are in the business cycle, and momentum, sentiment factors. Now, valuation is a long-term indicator. So things, valuation signals are probably a 7-year plus, in our mind, indicator. So things will look expensive for a long time or cheap for a long time. So a lot of our discussion was where we are in the business cycle. So in terms of where we are in the business cycle, from a business cycle perspective, yes, we still think there are positive indicators. I mean, if you look at, I guess, sort of the key economic metrics you see coming through, things like the PMIs and so forth, yes, there is a downtrend, and but they are still positive. And so there's still sort of room for expansionary, positive, I guess, policy which will for equities. But I think, and momentum has still been pretty strong from a shorter term perspective. So despite valuations being where they are, but having said that, I think that from a more secular perspective, it's looking at liquidity in the markets. And I think that's where what unhinges markets is you can have your discipline of valuation and all those things, but it's then sentiment and flow of money that has an impact. So we are seeing some risks there starting to pop up. So effectively, we're fairly neutral on a lot of the growth assets, but probably our biggest overweight exposure is alternatives, and we're holding a little bit more cash. And that's really more to say that we're 10 years into the cycle may continue. There's no red flags at the moment, but there are risks increasing. So rising interest rates, some of the data on the economy is starting to taper a little bit. So we've looked for more uncorrelated assets.
So Con, within the view within PIC, where do you sit relative to the ranges of the asset classes that you take into account?
Yeah, so we pretty much have got a moderate underweight to growth assets in aggregate, and pretty much similar to what Lucas said is we look at three fundamental things. So we've got your valuations, which are very key to how you construct portfolios. Then we're looking at your fundamentals, so profitability of companies or shares in general, and then the last thing being sentiment. And so if you look at sentiment, really, you almost have to go back like 9 years, 8 years there. It's very, very high. So the market really complacent. So whether you're looking at the VIX just before we had this recent slight correction, or you're looking at the amount of debt that is being taken to leverage equity portfolios, really it's kind of very, very high, giving you that sense that, you know, there's a kind of disconnect in terms of where valuations are versus where sort of people are wanting to keep on piling in money. And so we have been in this space maybe for the last while in terms of the aggregate growth assets expensiveness. So really, we think that there are pockets of value that are there. So if you look a layer below, so when you start to look at the styles, you find that a lot of the portfolios, they will be kind of overly exposed to things like your momentum factors, to your sort of dividend factors that overly skew portfolios. And so we will prefer to sort of have some tests done on the combination of your sort of equity composites, just to see, you know, whether you've got a balance of factors that if any of these sort of significant risks hit the portfolio, at least you're not too overly exposed to, say, your growth factors, momentum factors, particularly with having a very sort of long bull market. You find that your sort of large caps would have been carrying you, and the reverse cycle can sort of easily take place and overexpose the portfolio. And
when Lucas spoke, he talked about that now we're moving back to a time for active management instead of beta exposure. Do you guys have a view on whether that's in fact the case, that we should be favouring active managers or style or particular styles?
Precisely. So we, at this point in time, we prefer to have active managers, particularly if you look within the Aussie market, where obviously because of the concentration risk, you take into account the property market, you take into account the banks, and your index. If you say, for example, just take the ASX 200, huge concentration risk there. So we feel that especially whenever you are in a late cycle, active managers, they tend to really outperform in sort of market corrections. And so we think that there could be value extracted there. We also think that even within global equities, there are pockets of value. So for example, if you look at the US market, a large chunk of the of what's driving the market up is, we feel that is the potential share buybacks. There are numbers being thrown out there, but some of them are talking about $1 trillion of share buybacks in terms of US companies. But if you look at the European market, there are some pockets of value there, a bit of emerging markets, despite the sort of underlying risks. So we think that if you just look at aggregate valuations, yes, markets are expensive, but there are some pockets of value that can be extracted, and hence why active management.
Probably one of the interesting comments specific to managed accounts. So, I mean, a lot of this stuff is applicable to any sort of investment structure, but for managed accounts, I mean, I think the interesting thing, and I've observed this with some portfolios, not across the board, but if you think about managed accounts, there are multiple layers of fees, right? So there's the underlying investment management fee, there might be a model management fee, and if it's an SMA or something, it could be an RE fee, and then obviously platform fees. So one of the things that we've sort of seen in managed accounts is a lot of clients sort of say, well, we need to get control for cost, total cost of the portfolio. And in a bull market, and we've seen this, there's sort of been this sort of assumption, well, you know what, you just get beta exposure, that's cheap. And there's nothing wrong with cheap beta exposure if it's driven by an investment thesis, right? So we still will have some exposure to cheap beta. But I think the danger is that the exposure to cheap beta is driven by a structural thing of the investment structure rather than an investment reason. And so it'll be interesting to see, you know, they may even talk about Aussie equities. There's been an assumption, I would just get some cheap beta and it's fine. Well, that may not necessarily work out as well if we do get an environment that is more volatile and you get more dispersion in returns and dispersion in between sectors, stocks, and so forth. So probably just a point worth making.
So does smart beta there have a role in your thinking in trying to address that sort of combination of
it
cost
does.
and
it's interesting actually. So, I mean, you've got to look through what the rules are with some of these smart beta strategies, because some of them can be very simplistic, and they work until they don't work, right? But I think we have been monitoring some of these smart beta strategies. So, for example, the quality factor. We've seen quality as a factor. If you look at any, say, global equity manager, has done pretty well over the last sort of 8 years or so. So one of the things we've sort of done is look at, well, if you look at the quality managers and then you get a smart beta quality factor, to what degree has that been very correlated to the active, the fully active manager? And we found in some instances the correlation's been very high. So in that instance, you've got to say, well, first and foremost, has that manager really added a lot of value if really they're a quality manager above a quality sort of benchmark? And then if not, does it warrant a smart beta exposure, because you could probably get it at a third of the cost? So we have in some portfolios...
Shut your ears, Richard.
No, but we have... but that's the reality, right? So if you're... I think at a minimum, if you're a value manager, growth, whatever manager you are, from an investment perspective, starting to look at benchmarking against those smart beta indices to see whether, is it just sort of... Are you really adding, if you say a value manager above that factor? And then, so they have a role to play. We have used some smart beta strategies for components, where we found actually that, close, 80%, 90% of the time we're getting a similar outcome.
Are there other questions from the floor? So Richard, a question for you as a portfolio component, Antares is a portfolio component. When you think about talking with portfolio managers or putting together diversified portfolios, how do you position what you do as part of their broader strategy?
Well, we probably don't. We don't do that. I mean, we're just managing portfolios individually. We don't have communications with other fund managers when we're talking about. We don't have a role to play in a broader diversified portfolio. I'm not quite sure which.
My question was, if a portfolio manager, if Lucas, for example, asks Antares, where would we sit?
Right. Well, we have two particular areas. So there's one which is probably the older part of the business, and more of the retail part of our history. We started off as portfolio partners. Aviva bought us. Aviva then got rid of us, and we went to NAB Asset Management. We're one of the boutiques, one of the fund managers that sit below there. Some of the funds that came in through Aviva are very much income or core, if you like, strategies. So we've got the dividend builder and the core strategy, and they are quite distinct income products or almost a risk management tool as they're used in within MLC. Then we've got, I guess, the funds which I more actively market to institutions and which are also on our SMA platform, and what I call the high alpha strategies. So we've got a 30 stock portfolio, which is a broad large cap portfolio that Nick Pashius runs. He's got around about 1.5 to 2% since inception, which I think was around about 2002. Don't quote me on that. Which is a pretty steady level of performance if you want that large cap exposure. We've got mid cap exposure through John Guadagnolo's fund, which has had stellar numbers over 1, 3 and 5 years. So there's something there for most areas. Could I just address one question before this gentleman over here talked about what was mispriced, etc. What I didn't say, I was speaking more about bonds, but let me speak about what we know about more specifically equities. I do think at the moment, obviously, we all know that the growth stocks are overvalued. What we don't think about, what a lot of people don't think about at the moment, is to what extent they're overvalued and what role passive index funds have played in pushing them up. As someone who spent 17 years on the sell side, I can tell you right now, it will have had a massive effect, that momentum or shoving money into the large names on indices across the world, not just Australia. And of course, with a growth bent and frothy markets, that process is exacerbated even more. What I'm quite concerned about, and when you talk about what area is most mispriced, what I'm very concerned about is when we get a major market correction, and we will get a major market correction, there's no doubt about that, is the money from the index funds, the passive investors, and this is what they don't tell you, trying to get out of those names in a hurry. And it's going to be like a fat man trying to get through a keyhole. They won't be able to do it. So that's a concern for me, and you'll see a significant level of mispricing when that happens.
Can I just add something
Yep,
to that?
right, yes.
A bit of a passionate bent of mine is that it's not just the growth of that in the large cap space, but the expansion of those products into other markets that are even less liquid.
Yes.
Like
Yes.
high yield, emerging market debt, and all sorts of other markets for the chasing of beta at a low cost has created a massive mismatch between the ability, the amount of money that's in there, and the ability of that money to get out of that market when they want to. And it's definitely a risk in the big cap space, but it's much more of a risk in these kind of high yield and other areas where.
And Lucas.
Well,
Sorry, go on, Richard. Yeah.
excuse me, someone has been sitting here trying to, no, it was an alarm. Sorry.
I was going to say, Lucas, in his initial comments, said markets are driven by liquidity and leverage, and it's.
It has been the sheer weight of money, and when you work on an institutional trading floor and you see the big index funds and what they do every day, you know that's great. It's great for business. It's fantastic when you're an insto stockbroker, but it's got to come out when markets go down, and that's what people forget. And you know, the big index funds, and challenge me if you want, but the big index funds, I don't think have put enough thought into how they unwind their positions when markets correct. You know, we will find out who's swimming nude when the water goes out.
All right. Well, look, thank you very much. Please join with me in thanking our three panellists. On your table is a document, a white paper on managed accounts, which I wrote, as I said to MLC, 3 weeks to write it, 3 months to get it through compliance, based on the investment trends data, which MLC are the sponsors of. So take it away, have a read. It's, certainly the data is interesting and tells us that managed accounts really are a significant part of the advice industry. Just to put it in context, I've been thinking about this a little lately, and the total personal investment market in Australia, according to Rice Warner, about $5,000 billion, about $5 trillion. Platform market around 800 to 850 billion. Managed accounts around 60 billion. So it's part of the market that has an enormous potential for growth. In fact, we've done a little diagram on how it all ties together, which I'll be putting on our website in the next few days. So thank you very much for coming along. Con, Lucas and Richard, thank you for your participation, and we look forward to seeing you at future IMAP events. Thanks very much.